Hello my fellow investors. In this video I'll get into the point of analyzing the return on assets from the investor's perspective. Now generally I'm not planning on putting out content in my channel that's general knowledge and can be found in other channels or an easy checking up. I'm planning to put out only my analysis that I think gives the viewer a deeper understanding of the issue. But since there might be viewers who don't know the basic knowledge, I'll do a short intro before I get into the deeper analysis. So I hope the more knowledgeable investors will forgive me for this short intro. Okay, so let's get into it. When an investor is looking into a company, one of the first analysis they'll want to do is finding out how profitable and efficient the company is. Now, the way to find that out is by finding out how much is the company earning on their assets and equity. And there are other ratios as well. I hope we'll get into that in future videos. In this video, we'll analyze return on assets, which means how much is the company earning or how much money is the company generating from its assets. So of course, the higher the return of the asset, that means the company is more profitable. Now, if the investor knows all the ins and outs of the industry of the company, then okay. But if he doesn't know how much is it normal to be for return on assets, how much is it high, how much is low, how would he know what return on assets means the company is efficient, and what return on assets rate would mean that the company isn't efficient? So the basic and easy way to find that out is by comparing the company's ROA, which is return on assets, to the other companies in the same industry's ROA. So it's pretty obvious to point out, but I'll just say it anyways, that you shouldn't compare 1 year, but rather a minimum of 10 years. Like 1 year doesn't mean anything. If in 10 years you want to compare two companies, what happened in the past 10 years, each year and year, that's pretty obvious. Now, everyone knows that you have to compare a company in the same industry. You can't compare a tech company, which usually generates a lot of profits without the need of a lot of assets, to a highly industrial company, which needs a lot of plants and equipment to produce its products. So, the main point of this video is to analyze what return to use as the numerator in the formula. So, we could use all different kinds of returns. We could use the EBITA or net revenue, so we'll get into that later. So before I get into this, I want to point out two things. Let's say there's two companies in the same industry, and the investor likes both of them, but one of them has a higher ratio than the other one. And so the first thing what you would think is that one of the high ratio is a better buy, but that's not always the case. If the company with a low ratio, he can see that throughout the years has much higher growth, then of course that's a better buy. And whatever the ratio is, let the ratios be damned. The whole point of analyzing ratios is to see which company is more profitable. If you can see that one company has a consistently higher growth, then of course that's a better buy. And how could it be that the other ratio is higher? The other company has a high ratio. Maybe the company is undervaluing its assets or anything else. The end of this the whole main reason, the goal of calculating this is to find out which company is more efficient. So of course, the main thing is the growth. And if one company you can see consistently has a higher growth, of course that's a better buy. The second point is, even if one company has a higher ratio, if the company with a low ratio is trading at a PE of 5, and the company with a high ratio is trading at a PE of 20, then it'll be it'll take forever for the better company to catch up to an investor's buy at a 5 PE. If an investor buys a company at a 5 price earning ratio, he's earning 20% a year. And let's say the company also has a growth of 10%, and the other company is buying it at a price earning ratio of 20 or 25, and is earning 4 or 5% a year. That's a difference of 50% a year. It will take years for the bigger company for the better company to catch up to the company with this low ratios. So I'll just finish this part. I'll be very grateful if someone can teach me if it's possible for one company to have a consistent higher growth while the other company has a consistent higher ratio. Of course, I'm not speaking in a scenario that a company is very profitable but isn't growing its business at all, and therefore it has a high return on assets and no growth. No, if two companies, both of them are growing each year, consistently growing, and one has a higher growth and the other has a high ratio, I want to know if that's possible, if that could be. So if anyone could help me figure this out, I'll be very grateful. Okay, so let's get into how to compare companies' return on assets. So the first question should be, is which return should we use as a numerator to calculate return on assets? So I filled this whole spreadsheet with two companies. I did for a few days I was trying to figure everything out of my head, and I was I decided I'm first going to finalize my theory and then check it out in reality, if there's anything in reality that contradicts my theory. So we'll get into this. So I made a video of the 5 basic returns that we can calculate in returns. In this video, I made much more. That's the 5 basic ones. Over here, I calculated much more. I did 1, 2, 3, 4, 5, 6, 7, 8. And I'll put the link in the description to the 5 basic returns. So let's start with the worst possibility, to use the net operating cash flows as the return on the assets. So what I did in this spreadsheet, I took the two competitive companies. This is Wenagabu, and I put in under it, I put in Thor's. The 2 companies that produce the big manufacturers in RVs. And I put in all the data from 2010 and 2021. Now, this data, a lot of them is different than what you will see in the company's 10Ks, because I did a lot of different calculations. The net revenue is what is on the 10K, and the gross margin. The revenue, the cost of revenue, the gross margin, that's what's on the company's 10Ks. The EBITA I did by calculating the income, the operating income without depreciation. I'll get into that soon. So the first question is, should we use the net operating cash flow, which would be in the cash flow statements, as the return on assets? And in this video, I did the total assets of each company. That should be another issue by itself. What assets should we use as a denominator? So the net operating cash flow doesn't include depreciation. And for me to use a return without depreciation, so that'll be or the net operating cash flow or the EBITDA, which is earnings before interest, taxes, and amortization and depreciation. For me, that's a no-no. And the reason for that is the depreciation is a true cost. The company may be paying it another 10 years or 2 years or 5 years or 10 years, I don't know. But we can't just say the company is earning very nicely and taking off depreciation. That's a cost that the company will have to pay one day or another. So how can we just, if we wanted to calculate to compare 2 companies and we're taking off the depreciation, there's something wrong over here. That's not the true return of the company. But if you'll ask me, what's the problem if we're comparing 2 companies and we're deducting from both of them the depreciation? So maybe if you want to know the true return of a company, it would be wrong to calculate EBITDA or net operating cash flow without depreciation. But over here, when the sake is to compare 2 companies, so why not just compare the 2 companies' efficiency without depreciation? Depreciation isn't part of the operation right now. So if we're excluding from both of the companies' formulas, we're excluding the depreciation, what's the problem? So the answer to that is, if the investor will know the exact position of all the companies' depreciation for the next 20 years, okay. But if not, well, being the case, let's say this is the case of Wenagabu and Thor, which one company is much older than the other company. And usually an older company has more depreciation and more capital expenditures. So the investor could see the younger company has a higher return on assets of the EBITDA or the net operating cash flows, but in another 5, 10, 15 years, it might be way higher, the depreciation. So if we're trying to know how efficient the company is, we have to take into consideration also the depreciation. But we could still argue this point that it's not true, because right now we're deducting the depreciation for both of them. So who cares about the future depreciation? So what I'll say to that is that when we're analyzing a company statements, all the numbers that are there are the things that the company did do, but the company never writes what it didn't do. So what I mean to say by that is that if a company, an older company, has capital expenditures that it has to use. So let's say a company used $10 million on capital expenditures. If the company didn't have those capital expenditures, what would they do with the money? They would have used it to buy inventory or to expand or to buy acquire another company. I don't know. They would have used it for something else. We don't see that option on any income statement and cash flow. We only see what the company did do with the money, but we don't know what the company could have done and didn't do. The company could have decided to take that money, instead of using it on a capital expenditure, to use it on something else. So what I mean to say by that is, the older company, which has a lot of capital expenditures, the reason why it might have a low return is because they had to use the money for depreciation and other maintenance, while the younger company, which right now doesn't have those costs, is using that money to acquire more businesses. But another 5 years or 10 years, it wouldn't have that option. So that's why I'm saying we can't, in my opinion, we can't exclude depreciation when comparing companies. So just to finish this part, I want to play a clip of Warren Buffett with a few smart words of him and a few aggressive words from Charlie Munger. I'll put the link in the description. I'll recommend everyone to watch the whole video, but I'll just put a small part of the video in here.
So I think the EBITDA has been a term that has cost a lot of investors a lot of money. You saw it in the telecom field. I mean, the idea that they were spending money so damn fast, I mean, they couldn't have it coming in the door fast enough from investors. And then they pretended that depreciation was not a real expense. That's nonsense. I mean, it couldn't be worse. And a generation of investors were sort of brought up to believe in that. We at Berkshire will spend more than our depreciation this year. We spent more than our depreciation last year. We spent more than our depreciation the year before that. Depreciation is a real expense. Just as much as expenditure for life. It's not a non-cash expense. It's a cash expense. You just spend it first. I mean, the cash is gone, and it's a delayed recording of cash expense. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word you just substituted the phrase bullshit earnings.
Okay, so for me it's a positive that we have to take the depreciation into consideration. So the next question is, what about taxes and interest? So over here we have a ton of different options. We could decide to calculate. So we said we're not going to use EBITA, which is earnings before interest, taxes, and amortization and depreciation. So the next option would be EBIT, which would be earnings before interest and taxes, but after depreciation. Another option would be to use earnings before taxes, but after interest. Another option would be to use the net operating revenue, which is sometimes a little bit different because over here I calculated the EBITDA and the from without the depreciation. So over here, the net operating revenue in also Wenagabu and also Thor, they put in their income statements the amortization of intangible assets, but they put the depreciation in the cash flows. So over here, the EBITDA and the EBIT and the EBT is the earnings or before amortization or after amortization, before interest, taxes, or after taxes, before interest. But all of them are without the EBIT and the EBT are without amortization. The net operating revenue, this is what on the company's income statement, it excludes also amortization. So that's the difference between them. So that's another option. The third option would be to use NOPAT, which is net operating profits after taxes. So we could use or the earnings before interest and taxes, but after amortization and depreciation, or earnings before interest, but after taxes, or earnings before taxes after interest, or we can use the net revenue. And another option would be to use the net revenue after depreciation and amortization. So what I did over here, I took the net revenue and I deducted the depreciation and amortization that's on the company's cash flow. So the net revenue in this year was 10 million, but after deducting depreciation and amortization, so it was 3.9 million. So basically what I'm trying to analyze is, when we want to compare companies, should we compare after tax, after all the costs, depreciation, taxes, interest, or maybe we should do it the net revenue after taxes and interest, but before that's what I want to analyze here. So I'll break this down to two parts. So for me, it was pretty easy to decide that we should calculate the company after the taxes. We can't exclude the taxes, and the reason for that is because some companies, even in the same industry, pay different tax rates. I'm not an expert at all in taxes, but I think I'm pretty positive that companies who have a lot of business overseas pay a lower tax rate. So if you want to compare two companies, and one company may be paying a way lower tax rate, I think it wouldn't be smart to compare them by the earnings and the revenue before taxes, because if some company figured out a way to pay less taxes, that's also more efficient. What do I care if the company is more efficient because they have better personnel or better equipment or better way to pay less taxes? What's the difference? As long as they're doing it legally, what do I care? They're more efficient. So I think it's pretty simple to decide we need to calculate the returns after taxes. So the big question is, and this I was working very hard. I was brainstorming this issue for a long time. What do we do about interest? Should we calculate the earnings before interest or after interest? So I'll try to explain the two sides of the arguments, the way I look at it. So the first notion would be that we should calculate the net revenue after interest payments, because the company is paying interest. Look over here, Wenegabu in these years, from 2010 until 2016, it didn't pay interest. It didn't have any debt. Only from 2017 and on, they had interest. And Thor Industries, on the other hand, is paying interest for years and years now. It has ups and downs. So the first notion is, why should we compare them before interest? The company's revenue is after the interest. So the problem with this with this theory is that we can argue that if you want to compare the company's efficiency, we should compare the revenue before interest, because the interest is like an outside expense. We want to know which company is more efficient in their operations. If one company, now they're paying interest for some reason, but it's not part of the operations. If they wouldn't have had this debt, they would have been the same efficiency without the interest. So why we want to try to find out which company is more efficient? There would be a very strong sided argument to say we need to calculate it before interest, not after interest. So that was my first notion. That's what I was leaning towards for a long time, and I think it's not right. It's not true. And the way the value should be calculated after interest, and the reason for that is because we can't exclude the bottom line, the revenue, without taking into consideration how the company got to that point. So let's say Thor, yeah. In 2019, you can see the total assets of Thor grew from 2.7 billion to 5.6 billion. Thor acquired a huge company in 2019, and their returns are coming because they took on a huge amount of debt. You can see here the interest. They paid interest 5 million in 2018. They paid 68 million and 107 million, 94 million in 2021. Now we can't say let's take in all the returns before the interest, because these returns, the net revenue over here and over here and over here after they bought the company, came because they took on debt, and that debt is costing them a lot of interest. So how can we take the bottom line and say, sorry, how can we take the bottom line is the earnings before interest, yeah? How can we take that line and take out of consideration that line came because the company took debt and they have to pay debt, they have to pay interest on that debt. So for me, it's like taking only half of. We're trying to. What I'm trying to say is, if you want to figure out which company is more efficient, we can't just take the bottom line without taking into consideration how the company came to that position. So I'm leaning towards saying that if you want to compare companies, we have to take the net revenue after taxes. I think that's pretty obvious. That's what I think, anyways. Depreciation, I think that's for sure. And I think also you should compare them after interest. And so if we want to do it in a simple way, we could go into the company's income statement, and the bottom line would say the net revenue. But usually companies don't put depreciation in the net revenue. So if someone wants to analyze the two companies, they should take the bottom line, the net revenue, and deduct from that all the depreciation and amortization that's in the cash flow statement. I think that's the smartest way to compare two companies. And I just want to say, I was brainstorming this issue for a few days, and I did a lot of thinking about this whole issue. and I checked up tons of different numbers and calculations to see if it works or not. I did the compound annual growth rate for 10 years to see if anything doesn't work out. I calculated over here the return on assets and of the EBITDA and the EBIT and the EBIT and the net operating revenue, and the net operating revenue after taxes, the operating cash flow return on assets, and the net revenue after the depreciation and amortization. I calculated everything. I tried to check up to see if in the two companies, I didn't see here any number or any issue that would point out that my theory is wrong. But let's just say one thing: whatever you decide to do as an investor that wants to analyze two companies, that's one thing is for sure. You have to use the same ratio on both companies. You can't use one ratio for one company and another ratio for a different company. So I'll be very grateful if anyone has anything to teach me on this issue, if I'm right or wrong, or maybe anything to add on, or a point I didn't realize. I'll be very, very, very grateful for that if you could leave something in the comments. Thank you very much, and I hope you enjoyed this video.